Thank you for joining us for our third quarter strategy outlook titled Actions Over Words. What the title refers to is a somewhat unprecedented disconnect we're experiencing now between soft data, which is surveys of attitudes, versus hard data, which is actual economic data. Illustrations of that on the consumer would be consumer confidence or consumer sentiment, which is low relative to how consumers are actually behaving in terms of retail sales. From a business standpoint, the disconnect between soft data would be PMIs, Purchasing Managers Index, which is a survey of business expectations for demand, which has been negative, indicating contraction, yet businesses have been expanding. Now, it's been a wild ride for equities so far this year. Looking at the S&P 500 path so far, you see in April the market plunged. As you may recall, the threats of dramatic tariffs caused a lot of concern. Recession odds went from 20% to 65%, only to see the S&P rally to an all-time high by quarter end. We never thought there was going to be a recession, not even at the April 8th lows. Why? Because people are employed. Here we show monthly layoffs, and you can see in the yellow highlighted area, it's been trending up for the last couple of years. Monthly layoffs, the most recent reading was 1.7 million. Now, historically, before COVID, it trended around 2 million. There's a lot of churn always, people being laid off and people being hired. That's just the normal run rate, and it has been trending up. But the point is that the labor market has really normalized since the extremes of COVID. Right now, unemployment's 4.2%, which structurally is pretty much full employment. Now, in the extremes coming out of COVID, there was a big disconnect where there were 2 openings for every 1 person looking for work. And that led to a firm job market, which is great if you're employed, but it also led to a wage price spiral that we didn't want to see long term, obviously. Right now, things have normalized in the labor market. Right now, there's 1 job opening for every person looking for work. It's really a labor market that's softening, but softening from an extremely tight level to one that's in equilibrium. Now, to the title of our chart pack, this next page shows it very graphically. The blue line is the University of Michigan consumer sentiment. You see that it plunged during COVID and has never returned to those levels seen before. On the other hand, the sort of tan level below shows retail sales, and they've just taken a step function up. Unprecedented to have this level of consumer spending, in other words, retail sales this high, when consumer confidence is this low. Again, pay attention to what people are doing, not what they're saying. Now, tariffs have continued to be a sort of overhang and a big point of uncertainty, understandably, for investors and capital markets overall. Our point of view has been that the tariffs are going to be economically manageable. Again, a reminder, the U.S. economy is a services-based economy, roughly 70% services, 30% goods. It's the goods side that are subject to the tariffs, if you will. The numbers behind this are about 10% of all consumer spending is on imported goods. That's $1.7 trillion of imported goods that could be tariffed. There's another about $1.5 trillion in intermediate goods and raw materials that are imported that go into other products. The point is that if you have a tariff between 10 and 15%, which is our baseline, say take the midpoint of 12.5%, the range of inflation that could translate to would be somewhere between 0.5% and 1.5%. So we just took the middle and for our estimate for what the economic impact of what we think tariffs will ultimately settle out at is an inflation rate 1% higher and a GDP growth rate 1% lower. So again, higher inflation, slower growth, but not anything that's an inflationary spiral or something that's going to tip us into recession. Now, as far as what else is going on and politically here, right now the big beautiful bill is being debated on Capitol Hill. Quite frankly, this is business, unfortunately, as usual from an investment standpoint here. It looks like we'll have revenues of about $5 trillion and spending of about $7 trillion. Very disappointing that neither party seems to have the political will to try to deal with the hard issues and live within our means. What does this mean for investors? The fact is, this means higher rates, longer, lower growth over the long term. At some point, we'll be forced to live within our means. So related to our fiscal imprudence, in the quarter just ended, one thing that became an issue, at least a headline issue, was the threat of foreign selling of our debt. In other words, if we couldn't get our house in order, there's a threat, or even for political reasons, that holders of our debt, such as China, would sell it, putting upward pressure on our rates. And what we think is underappreciated is the fact that the U.S. owns the majority of its debt domestically here, both government as well as private individuals owning it. About 2/3 of our debt is owned by US citizens. And so the biggest holders are Japan, China, United Kingdom. And as you can see here on this next page, if any one of them were to sell all of theirs, it wouldn't represent a big percentage holding of our outstanding debt. Not that we would want it to happen, it would place upward pressure on rates, but probably not to the degree that people think. Now, if you look at the bond market and what the bond market is saying about the economy, the bond market agrees with us. If you look at the yield on the 10-year Treasury, which is currently 4.2%, what the bond market is saying, the economy is what we would say in a stable zone, not too hot, not too cold. In this page here, we have the green highlighted portion in the middle of it reflecting a yield on the 10-year Treasury of between 3.5% and 5%, meaning at that's the sort of just right. We've seen, and we saw it earlier in the year when the yield on the 10-year was approaching 5%. 5% tends to be sort of a point where it becomes an impediment to equity markets, not only because of a competition for funds, but also the discount rate, the math, so to speak, of discounting future earnings. It becomes an impediment to the market going higher. Conversely, if rates go too low, somewhere below 3.5%, that starts to telegraph economic concern, recession fears mounting, which is also not a good environment for equity. So again, the bond market is telling us that we think things are about just right, not too hot, not too cold, kind of like the labor market, so to speak, and validating that. Now, equities have had a surprisingly good run so far this year, and the star has been international equities. The S&P is up 6% through 6 months. International equities are up 18%. At the beginning of the year, we said that international equities were cheap, but cheap wasn't a catalyst, that earnings mattered. And quite frankly, that was the wrong call because international has been the star. About half of that return has come through a weakening dollar. The other half has come through, quite frankly, some earnings that have been stronger than we expected due to European stimulus, some robust Chinese technology stock performance, and just quite frankly, stronger earnings growth abroad than we had anticipated. We entered the year underweight international. We're glad that we have what we have. We're not going to chase that at this point in time, but that's been the star so far of the equity show. In our last quarterly video, we finished by taking a look at 3 things that we looked at that would be indicators real time that we pay attention to that would cause us to perhaps change our view. We talked specifically about credit spreads, and last quarter, credit spreads signaled that we didn't see an economy that was in distress. This quarter, we're taking a look at earnings revisions because historically, as earnings go, so goes the market. And what we've highlighted here in the bars is month by month, the earnings progression so far this year. In other words, we began the year with expectations for earnings growth of 13%. Now, as we enter the third quarter, earnings expectations and at least growth this year have declined steadily to about 9.5% now. If we get 9.5% earnings, that'd be a great year. So the point is that things are softening, the economy is slowing, but still from a decent level. Our attitude going into this year was that we've had 2 solid years whereby the stock market has done better than earnings have grown. And so this year was going to be a year where earnings would grow more than the market would return. In other words, a sort of normalization here. And that's what we expect to see. Right now, the S&P is up 6%. Earnings growth is about 9.5%. We may have already enjoyed virtually all of the return we're going to see so far this year. So why stay with equities? Because quite frankly, we're halfway through the year. And at this point, the market is looking ahead and starting to discount not this year's earnings, but 2026 earnings, which are expected to be double digit. So though the market is not cheap, S&P is trading at 22 times earnings. Earnings growth and the expectation for continued earnings growth keeps us leaning into our overweight to U.S. equities. So to summarize, labor market is softening, but it's in a very healthy sort of normalized equilibrium point of view right now. Despite consumer nervousness and uncertainty, the consumer continues to be engaged, they're employed, and they continue to spend. We're not going to have a recession with the consumer employed and spending. As far as trade and tariffs, we see some de-escalation underway. The market, and at least the market levels, is starting to tell you that the market is agreeing with us too, that whatever the economic cost of tariffs ultimately will be, it's going to be manageable from an investment standpoint. Speaking of validating things, the bond market is signaling similar that the economy is in decent shape and sustainable shape, and we're not heading into recession anytime soon. And finally, as I just mentioned, earnings growth supports the elevated market levels that we're seeing now, and that's going to be justified by earnings growth as we start to look to next year. Thank you so much for your time and attention. Have a great summer, and we look forward to seeing you in the fall.